You are listening to Mining Stock Education.
I'm Bill Powers. Thanks for tuning in to Mining Stock Education. And today's show is a compilation episode dealing with investor misperceptions and common investor mistakes to avoid. You're going to hear from guests dating back to 2018. You'll hear from CEOs, geologists, newsletter writers, mining entrepreneurs, stockbrokers, and common investors like myself. First, you're going to hear from Steve Letwin. He's the retired IAMGOLD CEO, and he talks about investor schizophrenia. Let's listen to Steve. Considering you're now retired as the CEO of IAMGOLD, perhaps you can be a little more candid at answering this question, but what perhaps frustrated you the most, or what misconceptions did you see with investors regarding their expectations of you as a CEO of a gold producer?
Schizophrenia would be a word that I would use, and I'm not being hopefully overly critical. When I joined the company, there was a big emphasis on what I call long cycle economics. So capital was king. The concern was reserves, exploration programs that were fairly robust, etc. So gold prices are moving up at an exponential rate. Every discussion I had at the various conferences tied to long cycle economics. As soon as the gold price started to move down, that was thrown out the window. So I'll give you a quick example. We sold a deposit, Tarkwa Damang, in West Africa, in DRC, and we sold it to Gold Fields, and we netted $667 million after tax on this sale. And it was a phenomenal deal for IAMGOLD shareholders. Good deal for Nick Holland at Gold Fields at the time. But I got massacred by investors who said, "What are you doing selling ounces?" We had an 18% interest. Cost structure was going to go through the roof. Reserves were challenged. And this was like a 37% IRR. Not joking. And they were angry with me. They said, "You should not be selling ounces." 2 years later, they said, "That was the best deal of your career." And it was, by the way. So they moved from long cycle economics to short cycle economics. What do I mean by short cycle economics? Something that's going to throw off cash flow fairly quickly, less than a 3-year payback on investment. And they wanted to see a self-funding model where you're not coming to the investor for equity to build projects. You're going to use your excess cash flow to keep the business sustained or grow the business. So they moved from, please come to the market, $8 billion worth of equity financing in 2011 to $2 billion of equity financing on a good day in 2016. So you saw this transition from give me the long cycle to short cycle. And you may see people go back a little bit to long cycle here, simply because they can see the fact that capital has been really scarce and reduced in terms of reinvesting. You see that in the oil and gas space as well. So they may come back a little bit, but I think they're going to stay in the short cycle frame of mind for some time here.
Now you will hear from Brian Christie. He's a director at Wallbridge Mining. He's also the chairman of Fury Gold Mines. He used to work as a geologist. He was also an equity mining analyst. And Brian, in a previous show, talks about how investors can get short-sighted and lose the long-term perspective that they need at times. Listen to Brian talk about what investors get wrong. When you were at Agnico Eagle leading investor relations, from your vantage point, what did you feel like investors misperceived or got wrong the most?
Probably the timing in the cycle. As I said, they often tend to buy when prices are ramping, and that's often difficult because you never know when the price is going to roll over. I also think now there's too much short-term focus on earnings, quarterly earnings, a lot of that is generated by the hedge fund community, because those guys have become some of the dominant institutional investors with a lot of the big brokerages, whether it's in the United States or Canada. There's kind of a list of maybe about 80 of them, and they're the guys that are doing the trading. They're the guys that are shorting, going long, and everything's this short-term focus. And I think as an investor, you need to take a longer-term focus. Like a company every so often on a quarter is going to miss earnings, but if they miss earnings by a penny, is that a big deal? No. Because then the next quarter, they're going to beat by 2 or 3 cents. So that kind of thing, you kind of got, that's kind of noise. As I said, always look to see if there's a fatal flaw somewhere, then that's a different story. But, you can't really focus on the short-term trading. And you probably have some clients that do short-term trade. But again, as I would say, if you buy it in the right time at the right point when it's not, running up to the moon, then I think you've got the ability to trade, take some money, and, just be smart about it.
Next, you're going to hear from Rick Rule from my first in-person interview with Rick at PDAC in March of 2018. Rick talks about the most important thing that speculators need to analyze, and that's what he says is between your left ear and your right ear. He also talks about time horizons and how investors also get that wrong oftentimes. And he talks about how every investor, when you speculate, needs to come up with a probabilistic risk reward for that investment. Let's listen to Rick.
The speculator needs to look to the right of their left ear and to the left of the right ear and analyze themselves as a speculator before they determine the type of speculation that they go into. Because the way that the investor approaches speculation, the speculator's time frame, the speculator's skill at trading or lack of skill in trading, the speculator's reward expectations all go into the outcome. There was a point in time when what worked for speculators was optionality. You buy very, very, very large gold deposits that weren't going to make any money at $700, but could make a lot at $1,500. Those stocks, went up 500 or 600%. That was a good deal at that place in time. There are other speculators many speculators who think that their time preference matters. That's a mistake, but you have to acknowledge the mistakes that you're willing to make. Many speculators seem to have trouble holding stock over a long weekend. And I think that's a function of the fact that they don't know the companies that they've speculated in very well. They have no confidence in their judgment. For myself, everything with me is about probabilistic risk-adjusted rewards. And when I look at mineral speculation, even development stage speculation, my expectation is failure. In other words, I expect that in 10 decisions, I'm going to lose money on 5 or 6, do okay on a couple, and hopefully I'm going to whack the ball out of the park once or twice. I also prefer personally to ask questions where the answer begins with when, not if. So if I'm speculating on something where there's a probability that I'm going to be right, but it might happen 3 years from now or 4 years from now, I'm inclined to do that. Most speculators don't have a time preference that extends past months into years. And I would say if you look at my record over 35 years, my success has come from 2 things. It's come from backing very good people, and many other people don't discriminate as well as I do. But it's also because of my preference for the when issue, not the if issue, and the willingness to be patient when I knew that the answer began with when.
In this next clip, you're going to hear from mining entrepreneur Ross Beaty from an interview I conducted in 2021. Ross is going to talk about how investors need to have a long-term perspective, not only with their mining investments, but with how they view mining jurisdictions. Let's listen. You touched on cyclicality there, where you mentioned you can kill the mining industry for 30 years. It takes 30 years to jump back. You went into Ecuador when Ecuador was out of favor with investors because you saw the geological potential. And so you developed projects, and then now the situation is more favorable. Can you talk to the average speculator that's listening to us about the cyclicality of how these jurisdictions can go from favorable to mining to unfavorable, back to favorable, and hitting that coinciding with the commodity bull market, in this case, gold, silver, copper that we're talking about?
Sure. I think that the bottom line there is that mining is a long-term game. You know, from discovery to production is maybe 20 years, and then you get into production for, in many cases, many decades. So it's a long-term game. Politics is a short-term game. And if you're trying to build a mining company or mining business in a country, you just have to have your eye on the long term. And everywhere, you get these cyclicality, you get these cycles of political change. You have, let's just say a left-leaning government for a while, then there's a right-leaning government for a while, and that begets change. They all change around, and typically the cycles are much shorter than sort of mining cycles. So I don't actually do too much, navel gazing in terms of where to go, because I've found that, mineral projects last a lot longer than governments. And, you can't be too clever about trying to predict the future. There's only one guy who really knows what's going on in the future, and that definitely is not me. So you have to have a strategy, I think, of holding your nose if things are not so good and hoping they'll change. But in the meantime, keeping on exploring, keeping on developing, because it's a long-term game. And, to some degree, you've got to be diversified, so that if change happens in one place, it's maybe going to be better in one and maybe not as good in another. But if you're in diversified locations, you're not going to be hurt too badly. So diversification's worked well with me. I'll come back to Peru as an example. We went into Peru in 1995. Peru had just come out of 10 years of triple-digit inflation, tremendous political strife, terrorism was just everywhere. You couldn't get power was failing all the time. I mean, the country was just a mess. It was a failed country. All of a sudden, a new government came in. A guy named Alberto Fujimori. He sort of took a big broom to everything, cleaned it up, got investment running again, and literally, it's been going now for 30 years successfully. So, if you had made your investment decision then on what had happened in the last 10 years, you never would have invested. But if you realize that, yes, change was happening and it needed to happen, it's been a home run for many companies, including mine. So you just can't be too clever and analyze things too closely. You've got to think long term and get out of the noise and look at the big picture.
Many mining CEOs and management teams pay themselves too much and can be incentivized by a change of control fee, so they sell their company while investors lose money, yet they cash in millions in a change of control fee. This rightly upsets investors. However, I interviewed Heye Daun, formerly of Osino Resources, about 6 years ago, and he talks about how you have to pay the right mining executive enough money in order to keep and retain them, but also how a change of control fee, the way it's set up, it's supposed to positively incentivize management to do the right thing and give up their salary at the right time. Heye Daun talks about how this change of control fee was one of the things that incentivized him to do an M&A deal earlier in his career. You and your co-founders have put a lot of your own money, investment dollars, into launching this company. So you're not just employees, but you own a large share of the company. What about mining execs that maybe they were an employee for most of their career and they don't have the capital that maybe you had when you launched this company? What would be reasonable compensation for them, considering they may not have as much in terms of investment dollars when they launch their first solo project?
Look, I mean, if you're hiring somebody who's not a founder of the company, then you're going to have to pay them, because if you pay peanuts, you get peanuts. But I think the issue that I have is that quite often, especially in the junior space, it's difficult. Well, it's very, very difficult to find good people. But the best situation you could be in is if you find people that are truly aligned, i.e. that are invested, that are not just hired guns, but that are part of the formation or the start of the company, the growth of the company, like in my case. I mean, in my case, I've been in the industry for 25 years. If I had stayed at Anglo or one of the other blue chip mining companies that I worked for, from a cash perspective, I'd be earning a lot more than I do now. And I have to ask myself that question sometimes. Am I doing the right thing? There's a significant opportunity cost involved. But I do this because, I like the entrepreneurship, et cetera, et cetera. Ultimately, I have to be compensated for that opportunity cost, though. And like in Osino's case, we do that through equity issuances and so forth. I know I'm not answering your question. Maybe you must just try and nail me down more directly, but that's how we do it.
And finally, Heye, what is your perspective on change of control fees? This is something that many investors that I've talked to are frustrated with especially when the management tanks the share price over 2 years by 50%, and then they make millions when they sell it in a merger or an acquisition. What's your perspective on change of control fees?
Well, I have strong feelings. I do think they are necessary because I'm not, change of control fees are there to deal with the agency problem. I'm not an economist, but I mean, in simple terms, the agency problem is, as a manager, you're there, you have a good job, but in order to look after the best interests of the shareholders, you must be incentivized to support deals if they are good and if they are accretive or if they did represent value to shareholders. And that's conceptually where these change of control payments come from. And therefore, I must be in favor of it. In fact, I've been in this situation myself with the last company we sold for $200 million. At the time, we had $40 million cash in the bank. We knew we had a great project. It was in 2012. We were living the dream. There was no reason for me to support the Beaty Gold transaction. At the time, we had a 3 times change of control payment. And in today's terms, I guess that would be seen to be excessive. In our case, we accepted the deal with Beaty Gold. And part of the reason we accepted it was because of the change of control payment. And in the end, retrospectively speaking, it was the right thing. We did the right thing at the time. So in that situation, the change of control payment did what it was supposed to do. But I guess the difficulty that we have nowadays, and what you're referring to, is that in the last few years, there's been a lot of value destruction in the industry where management teams have gotten paid quite high sums of money regardless of the value destruction. And that's obviously wrong. But that's a problem with the structure of the compensation package, not with a change of control payment or a cash compensation as such.
In this next clip, you're going to hear from Rick Rule again. And Rick, in an interview I conducted many years ago with him, talks about how nobody can bottom tick and top tick a market. That is an investor fallacy and misconception if you think you can do that. And he talks about how many don't have the stomach or the understanding of what they own to endure the volatility in the junior mining sector on the way to a 10-bagger.
When I look back at my real long ball home runs, the 10-baggers, the 20-baggers, there are very few of those that didn't fall in price 40 or 50% during the time I held them. I look at Pan American Silver. We did the first financing there at 50 cents. Pretty good market. A few good market commentators in those days liked it. The stock went to $1.50. Then it went to $2.25. And, from 50 cents, the stock goes to $2.25. You're pretty smart, Then it falls from $2.25 to $1.25. And you're feeling less smart. The fact that it fell from $2.25 to $1.25 didn't mean that the silver assets went away or Ross Beaty lost brain cells or that silver wasn't a good place to be. Then the stock goes from $1.25 to $4 and you're feeling pretty smart again. Then it falls from $4 to $2 and you're doubting yourself. Could it go to $1.60? I mean, I know $2 is cheap, but could it go to $1.60? Who cares? Who cares? The upshot of all that is the stock goes from 50 cents to $45 and probably 4 or 5 times in the journey. And the journey only took 6 years, which is not an eternity, although it is to many speculators. The stock price probably fell by half 4 or 5 times. The idea that I could have bottom ticked it and top ticked it along the way isn't even a fantasy. The thought is stupidity. And it doesn't matter.
In this next segment, you're going to hear from Brian Leni of JuniorStockReview.com. And Brian's going to talk about why you must, before investing, know what you own and why you own it. And you need to write out your investment thesis and your price target so that you have some target in mind of when to sell. Listen to Brian now.
Type or handwrite a 1-page summary outlining exactly why you're investing in a company. You're going to want to write how much you think it's worth, what catalysts are going to propel it higher in valuation, and of course, what price you're going to sell it at. You know, for me as a newsletter writer, I continually write all my thoughts down, you know, including the recommendation articles on a new pick. And I'll tell you, it's 100% a major factor in why I've been successful more consistently over the last, 7 years since I've been doing this full time. It makes you crystallize the investment thesis. You know, you go through it in a logical manner. You go through that base value calculation. It's quantitative. There is definitely some qualitative, especially if you're in the exploration companies, to try to sort that out, how you're going to place value on a company that essentially has nothing. But it forces you to do it. And then once you have that baseline value established, you need to sit there and think, okay, well, why is the share price going to go up? Why is the market subtly going to take recognition? Besides the metal price going up, which is definitely one of the factors. But remember, there's a plethora of other things that can happen to make a share price go up. So you need to sort that out, and you need to sort it out over a certain timeline. So you write all this out in a very concise and compact format. And then finally, and arguably the most important point that it gets most overlooked, is what price you're going to sell at. Price targeting is something that you're not just going to pull out of your head. You have to say, okay, this is the base value. This is what the company is going to do in the next year. And this is what the share price should be after they've added all that value. Once they've done all that right, for most people, that's going to be the time to sell. And of course, it's market dependent, but these are the steps I think that most investors are going to have to take. And it'll solidify not only why you're investing in the company, but it'll also catch you if you've got too much emotion in the decision you're trying to make, or you're getting out of your competency level.
Next, listen to stockbroker and investment advisor Sam Broom from Sprott. Sam talks about 3 things that investors often get wrong. When it comes to your natural resource investing approach, what are the biggest investor mistakes that there is to avoid?
Sure, yeah. It's a bit of a minefield out there for newbies in particular. I think one of the key things you need to avoid, and if I look back to my early career in the sector, is falling in love with the stock. How many times you meet people that they just can't let go of something, it's not working out. They'll rationalize why it's not working out, when the best thing to do was probably to sell when the fundamentals or whatever changed. So I would say number one, avoid falling in love with stocks, and try and keep as objective as you can on the positions in your portfolio. The second thing I would suggest you want to avoid is trusting hype. So, whether you're on the message boards or reading newsletters or whatever you're doing, chances are the things you're going to hear the most about are the hypiest, the most promoted stuff. So unless you're in those things really, probably before you hear the hype, your chances of getting burnt, particularly if you're not in a raging bull market where everything's going up, is pretty high. So if you're hearing about something and the stock's already up 200, 300, 400%, just be very, very cautious, because chances are you're hearing it last and you're going to get burnt. So the last thing, the biggest mistake to avoid, I would say, is not to have any risk management in place. So depending on where within the natural resource space you're investing, that will, the risk management measures you can employ will differ. If all you do is invest in the junior space, it's hard to use things like stop losses because the liquidity in these positions are so poor that you can't be sure of, your stop loss measures working and things like that. So your real weapon is position sizing. You don't want to have too much, no matter what your conviction is, of your entire portfolio in a single junior name. That's just lesson number one. If you're in slightly more liquid names, so your larger sort of single asset development stage companies through to your mid-cap producers and majors, where there are decent trading volumes, you can be a little bit more secure in using things like stop losses. The real key is to have some idea of the level or something, some sort of trigger, whether it's a price point, whether it's a fundamental event or something like that, where you're willing to get out of a trade and admit defeat and say, yep, this one didn't work out. Because too many people buy into things, and either the story changes or they didn't fully understand the story when they got into a position, and they fall in love and they don't get out. So you need to have some kind of risk management with your investing and your trading.
Next, let's listen to Tyron Breytenbach. He's currently a junior mining CEO, but he also in his past career has served as an analyst and a geologist and is well-versed in the junior mining industry. He talks about how as investors, you got to be careful that you're not charmed by executives or promoters to where you make the wrong investment decision. And he also talks about how you could miss current opportunities because you're taking a past negative experience and filtering the current opportunity through that negative experience. Let's listen. What are some key mistakes that you've seen professional investors make? You've mentioned some of them, but any more you could share?
Yeah, there's two more I would share. The first one is people on the sell side can be very charming, okay? And sometimes investors end up doing things because they like spending time with someone, right? And I think if someone's managing my money, I want them on the ball. Like I don't want them rubbing shoulders with the guy because he makes you feel good. The second thing is we all have history, and I fall into this trap as well, right? Where you've had a bad trade, you've been burnt by an ore body, and then you won't see the next one coming. Like I missed Great Bear, right? I did not like it when I first met the company, and I eventually came around. But I just seen so many Red Lake discoveries fizzle. Because there's a saying that, you can throw a rock in the woods in Red Lake and hit a high-grade gold vein. Doesn't mean it's going to be a mine, right? And so I think a lot of investors, you'd show them something and they would have had a similar experience, or they'd owned the company in a prior iteration and they wouldn't touch it. I think a good example is Rubicon and Battle Lost, right? Like if you got wiped out on Rubicon, it's tough to go back to Battle Lost. But I understand that, right? Because some of these mental humps are just too big to get over. But I always admired the investors who could pivot when a story changed, and just be very, very open-minded.
In this next clip with Rick Rule, you're going to hear Rick talk about when and why he sold a Ross Beaty company. Oftentimes, as investors, if we're not careful, we could get emotionally attached to a leader, or we could like somebody who's in charge of a certain company that's going the right way, and therefore not sell. So we need to be able to separate our emotions from our intellect and our pocketbook. And Rick talks about how even though he invests with and supports Ross Beaty as a mining entrepreneur, there was one point with one company when Rick was invested in Ross's company where the probability of success shifted to the probability of likely non-success. And so Rick sold, even though he was good friends with Ross. Listen to Rick share wisdom in this clip.
You invest with Robert Friedland, Bob Quartermain, Ross Beaty, and these people. You said, one thing I would have done differently, you've told me in the past, is invest with them more often and not take a risk on more unknown entities to me. Now,
how true.
When you invest with these superstars, these now billionaires that have made you a lot of money, how long do you give them with a certain issuer they're in charge of, and it's not working out or they're not making you money? Do you call them up and say, hey, remember I'm a shareholder? Or do you view their current efforts through all the money they made you in the past? When does the darling status wear off?
I call them all the time. Not because I'm second guessing them, but rather because a press release, even a quarterly filing statement, is insufficient knowledge for me. I want the nuance. In terms of how much time I give them enough time until they have, until the probabilities are such that I need to sell. Ross Beaty did a deal that actually ended up working, but not particularly well, DeCapo years ago. And over time, it became clear to me that what he was attempting to do, he couldn't do, and he was going to embark on a salvage operation. Now, that's very admirable, and I've admired him for it ever since. But I wasn't going to victimize myself with his 3-year-long effort to salvage something that was going to have a subpar outcome. No knock on Ross. He didn't let it go to zero. He worked it out. He got it sold. he got it sold on reasonable terms. But that would have been dead money for 3 years, and dead money that was certainly dead money. In other words, the probabilities went from he's probably going to succeed to he's probably not going to succeed. So from my viewpoint, that's the circumstance.
In this final clip, you're going to hear from yours truly regarding discerning mining promoter claims. Oftentimes, as investors, when we're frustrated, we lose money, we can put blame where it doesn't deserve to be and not put blame, i.e. on ourselves, when perhaps it should be there. In this clip, I help you think through what you should hold promoters accountable for and what you should not hold promoters accountable for so that you can grow as an investor. All right, so the promoter makes statements, you buy into it, you buy the stock. Now, what are some examples of what you can hold a promoter accountable for? You can hold them accountable for forming reasonable, forward-looking claims of what is possible based on data. So, again, you have to size up this person. Are they qualified? Are they competent? Is their team confident? And is what they're selling reasonable? Now, I've seen third parties make some quite unreasonable forward-looking claims. You know, you could hear a promoter say, we're hoping to find a 2 million ounce gold deposit. You know, they probably won't be successful, but that's not such a ridiculous claim. But then when I've heard, we're trying to find a 100 million ounce deposit, when you hear something like that, that's just too over the top. And I've seen, going back to 2017-18 and the whole craze around Novo Resources, I remember at the time that there were third parties, not people who work for the companies, talking about the potential that this deposit could find billions with a B ounces of gold. And I mean, I was a newer mining investor at that time, and I was like, wait a second here. What's the average? I looked, you could just do simple things. I looked and said, what's the average gold deposit size even now? Found out. I went to some gold companies. They're like, okay, they have 3 million here. They have a 500,000 ounces here. They have 2 million ounces. And this person is talking about it could be billion of ounces of gold. That is an unreasonable, quite frankly, ridiculous estimation of what could be. Again, the lead promoter didn't make it, but a third party did. You can hold a promoter accountable for false and intentionally misleading information. I'm not saying the person that made that multi-billion-dollar potential claim, I'm not at all saying that they were trying to be intentionally misleading. I'm just saying that I didn't think the data warranted such an outlandish claim. But there are people that make false and intentionally misleading information. They're called liars. And here's the thing, though. Usually, like, I've hired people running small businesses, and two things you don't know fully about them. You can try to size them up in a job interview. You can call their references if they give you those, but you really don't know if they're truthful and if they work hard until they're put to the test. And then the real person over time begins to come out. So I think you can do the best you can do, but then it's like over time through observation and observing what they did or didn't do, that's when you can really learn about a person. And so you can hold a promoter accountable for their work ethic and effort. And I can tell you, some people work harder than others. Murphy's Law again. If things could go wrong, they go wrong in this sector. What is that promoter going to do when things go wrong? Are they going to work every avenue to try to move this difficult situation forward, or are they going to fold? Something you can hold them accountable for is timely communication of material information. And I've been a shareholder of companies that have had significant material information, including an event that would then basically cause the destruction of the company, and it was not communicated to the market in a timely way. And that is not how you run a company. And that is unfair to everybody, including your shareholders, because when a certain group has information that they can act on before everybody else, that gives them an unfair and an illegal advantage, because management is the steward of the company. And if there's material information that's going to affect the value of the company and its potential success or failure, you need to get that out to the market as soon as possible. You can hold a promoter accountable for publishing promised drill results and in a timely manner. I think it's horrible when a promoter sells an exploration story and they do it to raise money and they get people excited who buy the stock. And they're buying because of the value that could be created, of course, by successful drill hole. And then they hit dusters and they don't even report the holes. I don't even know how some can get away with this, but it does happen. Or they just bury it somewhere rather than saying, these are the results. And I know we promoted the blue sky up to 80,000 feet. Well, it's none of that. It's a bunch of dirt is what we found. They got to be forthright. You got to tell the market that. You got to tell the market that in a timely manner. If you know you hit dusters, give investors that information because they bought your stock with the anticipation of getting a positive result. You didn't get the positive result. Tell the market and do it in a timely manner. You can hold them accountable for making promises that they don't keep and not providing a reasonable explanation. Things go wrong. There's things out of their control. When that happens, they need to be able to provide a reasonable explanation of how they're going to handle it, but also when they make promises, and if it's not kept for a certain reason, if I'm a shareholder, I just call them and say, you said that this was going to occur. Why hasn't it? You said we would be drilling in May. It's now October. Why haven't, I wouldn't wait that long if I was invested. I would call them earlier, but I would say, why haven't you had the drill rig out there? And if it's not a reasonable explanation, then that is your reason to sell. And so they need to be able to provide reasonable explanations for failure and missed timelines. And I know a bunch of CEOs, and I actually have sympathy for the ones that I think are good because of the difficulties that they are faced and the timelines that they are missed. It's their job to try to put out a reasonable timeline. But sometimes the financing doesn't come through on time, or the permit is delayed, or the drill rig contractor has a mechanical issue that sets them back a month. There's reasons for failure, and you should be able to be provided a reasonable explanation for the failure or the missed timelines. You should be able to determine whether their compensation is appropriate. And by the way, what I've seen is sometimes after a failed mining speculation and an investor is like, they just hate management and they're just tearing them up online in a chat room, whatever. Then they're like, and this guy paid himself $450,000 a year, to lose me my 20 grand or whatever you invested. They didn't know that this guy was being paid $450,000 a year to run this $8 million market cap Explorco when they bought the stock, but now they're upset about it. Well, you should know that going in because that's data that you can access before you buy the stock. So I understand that you're looking for reasons to be mad with the guy or gal after it fails and you lose money, but hold yourself accountable. You should have figured out his compensation or her compensation beforehand and determine whether it's reasonable. And if you don't think it's reasonable, then don't buy the stock. There's certain stocks where I know that the lead promoter is paid over $500,000 for a pre-revenue company, and he gets paid $500,000 and above for multiple companies. I won't buy his companies just because I think he pays himself way too much from multiple companies that aren't cash flowing. And so I don't agree with the compensation, and I'm not going to buy the stock just for that reason alone. Sometimes an executive sells, the promoter sells, right? You bought into the stock because of the blue sky, the what could be that they sold you, and then you see in SETI that they're selling their stock. You can call them. This is what I do, and I ask for an explanation of why did you sell the stock? You buy a stock for one reason because you believe it's going up. You could sell for a variety of reasons. I kind of felt embarrassed asking the question recently of one position I own because there was a disposition of stock at a time when I wouldn't think that the lead executive would be selling. I asked for the explanation, and it was given to me. In fact, to his credit, he emailed me. I didn't even ask for it. He emailed me. He said, Bill, I had to dispose of some stock. Here's why. It's part of a divorce settlement with my ex-wife. It was prearranged upon this catalyst for the company. Like this was determined a while ago. It has nothing to do with what I think the prospects of the company are right now. That's a reasonable explanation. It also made me pity and not want to be a CEO of a public company to have all of your personal business, out there because you need to tell the market why you sold. But it is reasonable to have a reasonable explanation for why are you selling stock when you're trying to get other people to buy your stock. Okay, examples of what you cannot hold a promoter accountable for. You cannot hold them accountable for the macro situation which causes a sell-off of your tiny junior mining stock. If the market is in liquidity mode, everybody's rushing to liquidity, they're selling everything indiscriminately. Gold is very liquid, so they sell gold, which causes the gold stocks to go down. And the general funds that had tiny exposure to mining stocks sell those stocks indiscriminately, and the whole market goes down. Or copper hit $5, and then it pulls back, and it runs back down to $3. Well, of course, if the copper price comes off 40%, your little copper stock is probably going to come off 70%. So that doesn't affect the fundamentals of what the executive can actually control. You need to be a judge of the macro situation. You need to know which way the winds are blowing. Is it in the sale of this tiny junior mining stock, or is it a headwind blowing against it? So you can't hold the promoter accountable for that. You can't hold them accountable for unfair government or local community actions which derail a project or a mine. One of my sponsors, Trilogy Metals, went through a 5-year consultation in Alaska for this road that they needed to build to the copper region that they're developing and their assets to connect to the Dalton Highway, which goes down to the ports, via which they would be able to transport the copper out of there. And so they went through a 5-year consultation process, a 1,500-page document, I believe. Everybody seemed to be on board, and they get their road permit issued. And that was under the Trump administration. And then under the Biden administration, a government bureaucrat unilaterally decides, I'm going to take that permit for which you work for 5 years to get and years of consultation, and we're going to take that back and look at this whole thing, spend years looking at this all again. That is one of the clearest examples, in my opinion, of unfair government actions that totally can derail a project or a mine. And of course, the Trilogy market cap and share price is going to tumble because of unfair government actions. And I'm not speaking for the company. These are my own opinions as I'm sharing this. But this is an example how you can't hold management accountable for that. They successfully worked for 5 years to get the permit. And then a different administration comes in and takes it from them. You can't hold management accountable for black swans, such as the virus in 2019 and the effects of it in February and March of 2020. I know that there were financings, and I really pitied a lot of junior executives. There were financings that were in place and soon to be closed during that period of time. And then when the market crashed in March of 2020, those financing, those deals were dead because share prices dropped by 40% in 2 weeks. And then the people that subscribed to the financing said, well, I'm not going to buy your shares at whatever, $1, if that's what it was being offered at, when your shares are now at 60 cents. And it totally destroyed those companies' ability to finance. They had to finance in the future after the share price had responded, but it sets them back, a year of activities. And because you need money to advance the project, so it sets them back. Nobody could have predicted that. It wasn't management's fault. They had the financing to subscribe to until the virus came in and the government response to it, and it just destroyed the share price. You cannot hold a promoter accountable for poor drill results if they were given to the market in good faith based on data with a thesis that was considered reasonable. Here's one that I see happen so often. You can't hold a promoter accountable for your unrealistic time horizon, your unrealistic time frame to produce the desired results. So if a promoter is selling the blue sky I'm just going to make up something, we're doing 20,000 meters over a period of 2 years. It's going to take us 2.5 or 3 years to get all the results, all the assay lab results in to analyze it. And at the end of it, we're hoping to grow the resource by 1.5 million ounces. Okay, so the first batch of, like, say, 4 batches of drill results comes in. They're not good. The share price goes down. And then maybe the macro situation turns over and turns bearish for the company. So the stock price is down 45% from where you bought it. Well, you sell and you say, I'm done with them. You didn't even give the promoter the time frame to accomplish what he or she said they needed to accomplish. They lifted up the blue sky, this amount of resource growth but I'm going to need 2.5 years to get it done. And you sold after 6 to 8 months because the first round was bad. And then the macro situation turned over and the share price went down. Okay, so your time frame was not even a lot in line with what they publicly said they needed to try to produce the desired results. You cannot hold a promoter accountable for your position sizing. Don't bet more than you can afford to lose. Remember those risk assessment acknowledgments that I went through that you have to sign to be an accredited investor? And by the way, those, what I shared with you, those risk assessment acknowledgement forms that I have to sign as an accredited investor, those are from an actual subscription that I filled out, maybe it was like 6 months ago for a little base metal junior. When I did my due diligence, I was buying shares in that placement at half of the average cost basis that management got their shares for. Well, guess what? Because of the market conditions 6 months later, the stock price is 50% below what I bought my shares for. That's how it goes sometimes. And there's no liquidity. All we need is a couple buyers come into the stock. I have no question that the stock's gonna rebound in the right market, and they still have cash. I'm not worried about it, but such is the nature of junior mining stocks. All right, here's a note. Being a promoter of a junior mining company, it can be quite challenging in a tough market. For example, many CEOs are currently faced with the decision, do I spend my remaining capital to drill and try to produce a catalyst? Because even if I am successful, the market is not going to reward me with an increasing share price so I can raise more money at a higher price. But if I don't spend the money and move the project forward, I'm not giving investors a reason to hold my stock. And I don't even know if I'm going to be able to effectively raise money without giving away the company at these prices. So being between this rock and a hard place is where many honest, hardworking, qualified, competent mining promoters find themselves. And I know that not just from observation, but from talking to them. And I've been told, we're in capital preservation mode because if I'm successful, I'm not going to get rewarded anyway. And the main thing I'm waiting for is a turn in the macro situation as it relates to the commodity we are exploring for. And when you get that from a promoter, then it's your job to assess, do I want to keep my money here?